Good morning, everyone. I think we can get started. Thank you for coming to the seminar organized by Garnet and the CGB. Before we get started today, I would like to begin by acknowledging the traditional custodians of the land on which our 4 Australian campuses stand and pay our respects to their elders, past, present, and emerging. Next, I would like to introduce the speaker. And the speaker of our webinar today is our own Professor Christine Brown. As many of you know, Christine is Professor of Finance in the Department of Banking and Finance at Monash, and she joined Monash in 2010 and was the first head of Department of Banking and Finance from 2014 to 2018. Christine's current research interests are in corporate finance, including share repurchases and capital issuance. And the theme of her Australian research has been the taxation treatment of different methods of capital management. Christine has made a significant contribution to the debate of shareholder equity and off-market buybacks, and advised the Board of Taxation in its review of off-market buybacks. Her current research interest questions the tax treatment of off-market buybacks in Australia, which is the theme of her talk today. If you have any question, feel free to raise your hand or type it in the Q&A, which I will raise on your behalf at the end of the seminar. You are also able to speak if you raise your hand at the end of the seminar. So without further ado, I'll now pass the virtual floor to Christine.
Good morning, everyone. Thank you very much for coming to listen to a seminar on tax. Only 2 sure things in life, death and taxes. So it's really good to virtually see people participating in these seminars. As Aoyong said, one of the themes of my research dating back more than 20 years now is tax treatment of share repurchases. So for those of you who are not familiar with this area, companies issue shares and investors invest in them. Companies also buy back their shares. So a share repurchase is the operation of a company buying back its shares from its shareholders. The particular focus of this talk is taxes and capital management, and the title is Tax-Driven Off-Market Buybacks, which we call TOMBs, and you'll see why that is an appropriate acronym, and it's time to lay them to rest. So the central argument is that there are tax distortions created by the treatment of these off-market buybacks and that have a cost to government revenue. So just some background before I get into some of the discussion and arguments. So share repurchases, as I said, companies in Australia can buy back their shares under certain regulatory restraints. And in fact, around the world, around the globe, repurchases have become increasingly popular since the 80s in the US and 1990s in many other countries. And of course, in the current climate, where we're in a crisis, the COVID-19 crisis, companies are very much trying to shore up their balance sheets because the share prices have been going down. And so these off-market buybacks, there's virtually been none this year, a few trailing ones at the beginning of the year. So perhaps the COVID-19 is going to kill them off in any case. So, but this paper is about these off-market buybacks. So there are 5 types of buybacks in Australia, and they're legislated and regulated. They're written into the Corporations Act, and the securities regulator, the Australian Securities and Investment Commission, regulates the conduct of buybacks, and the Australian Securities Exchange regulates what companies do when they're engaging in an on-market. So the first type of buyback is these on-market repurchases, or sometimes called open market repurchases, and they are not the focus of my talk. On-market repurchases are where the company goes into the market through a broker and just buys back the shares through a broker. And if you were a shareholder selling your shares into the market, you wouldn't even know that the company was the opposite party to that transaction. So they're a different type of buyback, and certainly I've done a lot of research into that area as well. But the focus of today's talk is off-market. Now, off-market just means that they don't occur on market. And so what happens with the off-market buybacks is that companies send out a prospectus to shareholders, inviting the shareholders to sell some or all of their shares back to the company. Now, the off-market equal access repurchase that I've got here is the type of repurchase that we're going to be looking at. And it's supposedly equal access. That's why I've got that in inverted commas. In fact, it's not really equal access, and I'll come to that in a moment. The peculiar feature of these types of buybacks where the company invites the shareholder to sell their shares is that the sale price can be broken into two components for tax purposes. And this is the focus of this paper around the tax treatment of these buybacks. The dividend component of the repurchase price can carry tax credits called franking credits or imputation credits. So that can be highly advantageous to shareholders selling into the equal access repurchase. The residual is the capital component is usually very small, and it results in capital losses. So the company is actually able to, with the approval of the Commissioner of Taxation, designate that the price be broken into these two components. And the capital component being very small results in capital losses, which can be tax advantageous. And the dividend, which correspondingly is very large, carries tax credits. So it's a double whammy. It's a double positive for the selling shareholder because they get the tax credits from the dividend and they get the capital losses from the capital component, from the capital component. The other two types of off-market are selective minimum holding and employee share scheme. We won't go into those. They're usually pretty small. So as the previous slide showed, the legislation provides for 4 types of off-market buybacks. But in fact, the terms, this is what I'm calling these off-market buybacks that are tax-driven. So that the terms, the acronym is tax-driven equal access off-market buybacks. The terms do not meet any of the types. So if ASIC, the regulator, didn't provide relief to companies, they wouldn't be able to undertake the terms. So ASIC provides relief to enable the companies to undertake a tax-driven buyback and to classify them as equal access, even though they're not equal access. So the basic premise there is that providing the company gives every shareholder an equal opportunity to tender their shares back to the company, then they're classified as equal access. Equal access would really mean that shareholders should be selling their shares back in proportion to the shares they own, but that's not the case. So there's an exemption for companies to undertake these. The next point basically says foreigners can't participate. And the reason for that is, again, legislation, that the securities laws in many countries would not allow Australian companies to invite foreign shareholders to participate without a much more detailed document than the invitation that goes out. So foreigners can't participate. And mostly foreigners wouldn't want to participate because foreigners cannot use the tax credits, the imputation tax credits. So by legislation, foreigners can't participate, but they probably wouldn't anyway. They generally are undertaken using a Dutch auction. So the company puts out a tender and large institutions and shareholders tender at which price they would be willing to sell their shares back, and the company gets to an equilibrium price for the sale. As I said before, the Australian Tax Office must approve the capital dividend split. So the company puts in a submission to the Tax Office. The Commissioner approves the breakdown of the buyback price into a capital component and a dividend component. The capital component is set and the dividend is residual. And I'll be doing an example a little later. That will highlight what I mean by these, a practical example, so that you'll get a bit of an idea for what I'm talking about here. The capital gains taxation calculation of the tax has become increasingly complex since the first of these. It's a very complex calculation. I mean, the arithmetic's not hard to do, but the actual theoretical or conceptual concept behind it is that the Tax Office got to the stage where they realised that that capital gains benefit going to selling shareholders was actually a little bit over the top in terms of the amount, and so they adjusted the share price for the natural movement of shares in the market. The Australian Tax Office puts an allowable maximum discount to the market price for the price at which companies can buy back the shares. Now, it's not clear what the reason for that is, and if we go back into the history of the legislation, the ATO was applying this maximum discount for a long time before it came out with a public statement about the fact that it was a maximum 14% discount. So there was a bit of uncertainty in the market. Now, the thing to note here for international scholars is that in other jurisdictions around the globe, when companies buy back their shares off market, often called tender offers, they usually have to do it at a price above the market price. Why? Because as soon as shareholders in other jurisdictions sell their shares back to the company, they're liable for capital gains tax. And so in order to entice shareholders to sell their shares, tender their shares back to the company has to actually buy them back at a price that's above the price that the shares are currently trading in the market. But in Australia, because of our dividend imputation system and because the dividend component carries these tax credits that are valuable to shareholders, the company is actually able to buy back the shares at a price that's lower than the market price. But that distance between the market price and the price at which they buy back cannot be any greater than 14% of the market price. In other words, maximum discount is 14%. Now these, I think it's true to say that tax systems everywhere are really complicated and they have lots of nuances. And the hallmark of a good tax system is, one of the hallmarks is simplicity. Well, I think our treatment here is anything but simple. The other aspect to be aware of is that in order for me as a shareholder to be, if I receive a dividend that's got tax credits attaching to it, then in order to be able to claim those tax credits back from the tax office or offset them against my other tax due, is that I must hold the shares at risk for 45 days. So in other words, I have to have held the shares for 45 days in a risky position in order to claim the tax credits. Now, what actually happens with these off-market buybacks is that the companies set the timetable so that investors in the market who don't own the shares can actually buy them when the company announces the buyback and hold them at risk for 45 days. And I'll come back to that, so you may not have quite got that. But the timing of the buyback, the announcement and the close actually allows enough time for that 45-day rule to be met. Now, there's been a tortuous tax history, regulatory history, since these products were allowed, including, as Ao Yong said, the Board of Tax did a review of the treatment of these off-market buybacks and eventually drafted legislation to change the treatment, which was never enacted. And it wasn't quite clear why it wasn't enacted either. The government really didn't come out with a public statement. So the legal requirements for share repurchases are contained in the Corporations Act. Legislation requires that when a company buys back its shares, it has to be fair and reasonable to shareholders, and it mustn't prejudice its ability to pay its creditors. So buying back shares and reducing the share capital or equity capital may make it more difficult to pay debt. So legislation requires that the company must protect its shareholders and its creditors. Companies can buy back up to 10% of capital without shareholder approval. So that's in a 12-month period. That's called the 10-12 rule. Now, in Australia, what actually happens when a company buys back its shares, the shares are automatically cancelled, and there's rules around how the company must do that. So when the transfer of the shares to the company is completed, the shares are cancelled. They're automatically cancelled. That is different from other jurisdictions around the world as well. For instance, in the US, companies are allowed to hold the shares they buy back in treasury and then can issue them for employee share schemes or whatever. But in Australia, no, companies are not allowed to hold their shares. Share repurchases just generally, both the ones that occur on market and these off-market ones, commenced in 1997. And we've been collecting repurchase data since then. So that's a long time, isn't it? You can see that I've been doing this for a while by my grey hair. So we've got hundreds of thousands of observations of daily repurchases for the on-market repurchases, and we've collected all the TOMs, the off-market repurchases. So the dividend imputation system in Australia is central to the tax arguments in this paper. When companies in Australia pay tax, they accumulate imputation credits for the company tax that's been paid. Those credits accumulate in this notional franking account balance. And to the extent that the credits accruing in that franking account balance are not needed for the company's ordinary dividend policy, then they're excess. And they're of no value to anyone unless they're distributed to shareholders who do value them. Because if the tax credits reduce the tax that you must pay on dividends, then that's to your benefit. So the system affects the company choice of payout between dividends and repurchases, and it also drives the choice of type of buyback. So you can imagine, and this seems fairly obvious, that if the company has accumulated a whole lot of tax credits in this account, this franking account balance, then that might drive the choice to do an off-market buyback so it can distribute those tax credits to participating shareholders. So there's a general research agenda here around the globe that what are the incentives for companies to do a share repurchase and pay out cash to shareholders via buying back shares versus paying out dividends. And in the US, it was found that when the tax rate on dividends is higher than the tax rate on repurchases, then companies tend to do repurchases. And by the late 90s in the US, fewer companies were paying dividends. They were doing large volumes of share repurchases because that was tax advantageous to their shareholders. The situation in Australia is different. Off-market buybacks don't substitute for dividends. And in fact, the companies that are doing these off-market, tax-driven off-market buybacks tend to be very large companies that are also paying sizable dividends. What we found when we did some research on this is that the on-market repurchases do tend to act as a substitute for dividends, but the off-markets do not. This slide is just showing you a reasonably recent paper that did an international study across 25 countries that shows that taxes do matter when companies are making choices as to whether to pay out cash in dividends or pay out cash in share repurchases. Now I have to keep moving. As I said, I've been doing this research for close on 23 years now, and this is just a little selection of the papers. The buyback started in 1997, and I think the first paper, there's a few papers sort of further back, looking at off-market buybacks. This is Australian research using Australian data, and that has implications for regulation and legislation, and also implications for tax treatment. There is a big tax debate going on, and has been going on for the last couple of years, around the dividend imputation in Australia. And some of this research feeds into that debate. The last highlighted paper here is the current one that I'm presenting today to you, published just this year in the Australian Tax Forum. We've sent it off to some of the legislators. I don't know whether it's going to have an impact in terms of changing the rules. So the off-market repurchases commenced in Australia in 1997, with the first one to do one was the Commonwealth Bank. We argue that they do create tax distortions which make it difficult for managers to make decisions that provide fairness in their treatment for all shareholders. Clearly, if a company does accumulate franking credits, it's more likely it will conduct an off-market buyback. Ao Yong and I have done a paper on trading around key dates in the buyback. So the company announces the buyback, and then it has a timetable, and then it announces that it's closed, and it gives the results of the buyback to the market. It turns out that it's only advantageous for low tax rate shareholders to participate. And so the low tax rate shareholders are basically superannuation funds, our fund, on a tax rate of 15%, and shareholders on a tax rate of 0, and that would be pension funds in pension modes on a 0 tax rate, or charities, or self-managed super funds. For you and I on a higher tax rate, it's actually not advantageous to participate. So the participating shareholders gain. The question is how much they gain, and the non-participating shareholders, the ones on higher tax rates, they don't gain as much. They gain a little bit because the company's buying back the shares at a price below the market price. So that's a positive net present value investment for the company. So the non-participating shareholders do gain, but they don't gain as much. And the fact that the tax office limits the discount to 14% means that the non-participants don't get as much advantage as they might if there was no restriction on the discount. And in fact, in another paper, we show that the equilibrium discount to market price would be about 20%. So these off-market buybacks are quite small in number. There's only, I think in our paper, there's 64 of them. But they involve very large companies and very large amounts. And in fact, even though there's only 60 odd of them since 1997, these tax-driven ones, they have distributed about the same dollar amount as the very much larger number of on-market repurchases. As I said, the repurchase price is part frank dividend, part capital component. Repurchase price is less than the current market price because of the tax benefits. And what it does, this is really one of the crucial points of this paper, is that because only low tax rate shareholders participate, what this structure enables is that the franking credits, the tax credits, are directed or streamed at the low tax rate investors. So the structure allows the streaming of franking credits, which when the imputation system was first introduced was not to be the case. Franking credits were not to be streamed to participants who could avail themselves of them to the maximum. What we argue and show in this paper is that there's a significant cost to government tax revenue. It's approximately $2 billion in 2018. We argue that there's an inequitable treatment of different types of shareholders, that the regulatory and tax determinations are very complex, so it's not good policy, and companies have alternative ways of distributing cash and franking credits. So our argument is that time to lay them to rest is a graph of the number of terms and the value. So the number on the right, you can see that there's not many more, the big ones, there's only sort of half a dozen of them each year since 1997 when the first one was CBA. There aren't any in 2020, not sure why that histogram at the end's there. It's a glitch in the Excel program producing it. So you can see that the amount spent on the left side. The left axis is in thousands of millions, so billions. And the franking credits, the tax credits, obviously follow the amount that's distributed because the franking credits are attached to the dividend component. Excuse me while I have a drink. So I'm going to now do an example just to make concrete concepts that I'm talking about. So back in November 2018, when its share price was $33.11 in the market, BHP announced a $7.3 billion term. It was via a tender commencing on the 19th of November and closing on the 14th of December. Now, the timing of the buyback actually enables investors to buy the shares immediately on the announcement and tender them into the buyback and get the tax credits because they would meet the 45-day rule. That is that they must hold the shares for 45 days to get the tax credits when they sell them. Tenders were invited at prices between a 10 and a 14% discount. So BHP writes to the shareholders and says, you can tender however many shares you want at discounts between 10 and 14%, I think in jumps of 0.5%. That's up to the maximum discount allowed by the tax office. So when it announces the buyback, it says, the capital component of this repurchase is going to be 38 cents. So the shares are trading at $33.11, and if you sell them into the buyback, you will be deemed to be selling them at a capital of 38 cents, and the remainder will be a franked dividend. You can see that the capital component can be very small and the dividend component can actually be the majority of the buyback price. The outcome was announced on the 17th of December. There were 265.8 million shares bought back, 8.3% of total at $27.64. That's the buyback price, $27.64. $64. So when you sell your shares into the buyback, that's the cash you get. 7.8 billion in total. It was at a 14% the maximum discount to the market price. The market price was determined to be $32.14. Rules for calculating that. And there was a scale back. So when the BHP went to the market and announced the outcome on the 17th of December, there was a scale back of 58.7% of offers submitted at the final buyback price. So the capital component was 38 cents and the franked dividend component was 27.26. Now, the capital proceeds were deemed to be $4.92. So you do not get to sell at a capital amount of 38 cents. Since 2004, that's been adjusted by a complicated calculation, and there's an uplift rule so that you're deemed to have sold them at $4.92 with a tax value adjustment. The scale back of the offers means that if of all the shareholders who tendered their shares to sell them back to the company, only 41.3% of the shares that you tendered would be bought back, and the rest would be not bought back. So when the company announces the closure of the buyback and the final prices, it also tells the market what the scale back was. And then, of course, if there are participants in the market who bought the shares on announcement to sell them back into the buyback, they will have bought maybe too many, and then they'll have to sell, particularly fund managers who are trying to track the market. So who participates? We're going to do a really simple example, then come back to the BHP. So ignore capital gains and losses, which of course increase the benefits from participation. This is a really simple arithmetic example. Assume that the current price is $10, share price is $10, and the buyback price is $8.60. That's a 14% discount. So of the $8.60, 90 cents is going to be capital, and the rest of it, $7.70, is going to be a franked dividend, fully franked dividend with $3.30 worth of franking credits. So in order to determine who participates, the counterfactual that we use is you either participate to sell into the buyback or you don't. And the comparison is between selling into the buyback versus selling at the market price. And the market price here is $10. So if you're zero tax rate, you get $8.60 plus a tax rebate. So if you participate, you get $11.90. And if you don't participate, you can only sell them on market for $10. So you would participate if you're a charity or a super fund in pension mode. A super fund, the comparison is slightly, benefit is slightly lower. You get $10.25 for participating because you only get half of the franking credits because you're on a tax rate of 15% versus the company tax rate of 30%. So it's marginal, but you would participate because think about it, the super funds are going to be participating in very large volumes of shares. So it might only be 25 cents a share, but if you're selling hundreds of thousands of shares, then you might as well have that cash as a tax office. For a 30% tax rate investor, they do not participate because you get $8.60 and the tax credits you get just offset your tax liability because you're on the same rate as the company, and the foreign investors don't participate. For the BHP example, we can work through the same numbers, and I won't go through the numbers again, but for the actual share prices and the purchase and sale prices, a superannuation fund would get $30.83 from selling the shares into the market versus $34.99 if they tendered the shares into the buyback and they were accepted. So that's a big difference. So the superannuation funds love these TOMs. They generate all these benefits. And in fact, many funds try to anticipate which companies are going to do these large buybacks. For a charity or a super fund in pension mode on a zero tax rate, the benefits are even greater. So you can see that these are very attractive to low tax rate shareholders. So this is one of the tables from the paper. This documents the market characteristics of the TOMs. There's not a lot to take from this. Shares bought over shares sought. Companies tend to buy back more than they seek because of the popularity. They tend to buy back around 5% of the outstanding shares at a discount of around 7%. The very big ones tend to be done at a discount at the maximum of the ATO regulated discount. Depending on how popular the buyback is, if it's really popular, it will be done at the maximum 14% discount. Franked dividends tend to be about 70% of the buyback price. There's on average around 48 days between when the company announces the buyback and to the closing date. So that allows shareholders or other investors to get in and buy the shares on announcement and then sell them into the buyback and get the tax credits. And the last two entries are the scale backs. So you can see that on average there's a 45% scale back. Sometimes the buyback is not that popular and there's no scale back. For companies where there is a positive scale back, the scale back is around 64%. That's a huge scale back. So you can see how popular these tax structured buybacks are. All right, I'm not doing too badly. I'm going to talk about what we feel are the main issues. And when I say we, I should have said at the beginning that this is a paper that's written with Kevin Davis from the University of Melbourne. I did have it on the opening slide. And we worked on this paper. It's been brewing in my head for a number of years. We worked on this paper when we were on sabbatical in Bristol last year. So the main issues, well, the first issue is shareholder equity or fairness. And that's been an issue since 1997. There was a lot of debate in the press in the late 90s around the inequity of these off-market buybacks because they stream the franking credits to domestic investors with low tax rates. And a lot of the argument was around, well, the dividend component of the buyback price is not really a dividend because under corporations law, a dividend must be paid pro rata to all shareholders. Whereas with this structure, the dividend is only going to the participants and it's only a particular class of participants with low tax rates. The low tax rate investors would actually accept a higher discount. Well, I've said that before. So the benefits accrue primarily to participants. The maximum discount leads to large scale backs. Low tax rate investors are unable to sell all their shares because they get scaled back. And so you can't actually work out what the benefit per participating share for specific investor tax rates because each investor is going to be scaled back to some extent. Second issue is the tax revenue consequences. And TOMs have a tax revenue cost. Because the franking credits are streamed or directed to the low tax paying shareholders, the tax collected is lower than it would be otherwise. And we were fortunate to find a heavily redacted Treasury paper that gave a breakdown of the approximate distribution of investors and shareholders in the market. And that enabled us to estimate what the cost to government revenue is. I won't go through the details here. If we ignore the adjustment to the franking account for foreign investors, 2/3 of the franking credits distributed via TOMs are actually a cost to government tax revenue. However, the ATO does apply a debit to the franking account balance for the non-wastage of the franking credits due to non-participation of foreigners. So the idea there is that if it was a dividend, a real dividend, and the company must distribute dividends to all shareholders, and the foreign shareholders can't use the tax credits, then basically those tax credits go to waste and they don't get claimed back from the government via reduction in other taxes. So the tax office had a formula to apply to these TOMs to adjust the franking account balance for the fact that the foreign shareholders don't participate. If you apply that, and the next slide actually talks a little bit about it, it brings the cost to the government revenue down to about half of the franking credits distributed. But in the paper, we actually talk about the fact that we can't, for the life of us, figure out where they get the formula from, and neither could any of the people that we wrote to justify the formula. And the formula does an adjustment only for the fact that the foreign shareholders are not participating in the TOM. It doesn't adjust for the streaming of the franking credits to low tax rate domestic investors. So that is the third issue. The third issue is that the debit from the franking account balance just doesn't make any sense. First, the formula doesn't make sense, and secondly, it's not debited for the streaming of the franking credits to low tax rate domestic investors. I think this is a big issue, and that is that when you go back through the archives, it's not really clear why companies are allowed to have 45 days between announcement and closing. That actually encourages the trading of the franking credits. And that was prohibited when the imputation system was first introduced. So that in itself also creates a cost to government revenue, and it leads to short-term market distortions, which are at variance with the tax policy, and it's at a cost to the long-term shareholders who might want to participate. The fifth issue that we raise in the paper is that there are other ways that a company could manage its capital. There are other ways that the company could, if it had excess tax credits in its franking account balance, there are other capital management techniques it could use to distribute the tax credits more fairly. And we go through a couple of those in the paper. It's actually the franking tax credits that, that underlie the popularity of the announced TOMs into the market. All the low tax rate paying institutions, super funds, charities, pension funds in pension mode, etc., they want a piece of the action because they get tax credits for it. The other thing that I should say, and I didn't, it's said in the paper, is that it was back in the Howard government, I can't remember the year, superannuation funds and zero tax paying charities, if you get your tax rate down to zero, then not only can you claim the tax, you can claim the tax credits as a rebate from the government. So that made these structures even more popular, because the zero tax paying institutions could get tax refunds on the tax credits. So my conclusion, time to lay the terms to rest. Here lies another tax distortion. So companies can actually achieve similar capital management objectives. The tax regulatory complexity belies the hallmarks of a good tax system. The terms allow the streaming of tax credits, which was explicitly prohibited when the imputation system was introduced at a cost to government revenue. The 45-day rule, we argue in the paper, is actually not applied according to the legislation. And even though we're advocating that they should be abolished, the superannuation funds, which have under management trillions of dollars, and the charities are going to be very powerful lobby groups. And so whether our voices will be heard, there will be a lot of opposition. Thank you.
Thanks very much, Christine, for sharing your insights. We do have a few questions in the Q&A. I think you'll be able to see it as well. The first one is from Vijay David Dai. He asks, is it also means that when investors doesn't have enough income tax to be deducted, then the tax credit, also the dividend, are considered as no dividend or low dividend, since the investors are not able to fully use it. So it has something to do with like the tax bracket and whether or not when two investors invest at the same price, same shares and same time, they may receive different dividend under a different system.
They certainly, thanks David. I think David might be one of my students. They certainly, the after-tax outcomes for shareholders in different tax brackets are different because the tax credits are used to offset tax liabilities. But as I just explained, and I can't remember when it was, in Howard, Howard was our Prime Minister. It goes back to, I think, about 2005. I'm just not sure. My memory for dates is terrible. But what Howard did was allow low tax paying, anybody, any institution or any shareholder who got their tax rate down to zero could actually get a tax rebate for the tax credits. So your question is saying that the dividend is not considered a dividend. Well, it is, because even if you're not paying taxes, those tax credits come back to you as a tax refund. So they're valuable.
Thanks, Christine. The next question comes from Paul.
Michelle.
Paul wants to ask a question live, so I think he's in there.
Sure.
Thank you. Christine, thanks for the presentation. I'm certainly going to keep an eye out for these in my self-managed super fund. I mean, you've given a very coherent explanation about why we should be filling our boots. But anyway, going beyond that, I'm just sort of wondering, I hear you say this, these schemes lead to an inequity between shareholders, but the whole imputation system is full of inherently involves inequity, whereas it discriminates against foreign shareholders, and they're a large slice of the Australian share market in the first place. So this, to me anyway, seems like a fairly minor inequity, and that if I see anything that seems odd, it's that ATO's rather arbitrary limit on the discount, which limits in a sense, spreading of the benefits, which would seem to be inherent and a deliberate part of the imputation system. That, you know, that would seem to be the inequity rather than the broader security itself. And likewise, the curious decision not to tax self-managed super funds in the pension phase, likewise, is a very curious feature of the Australian system that is hard to really justify on almost any basis. So I'm just sort of wondering whether the problem isn't so much these buybacks as the arbitrary ATO limit on the discount and the rather odd thing that we in fact have so many zero tax rate taxpayers who are at zero for no obvious reason.
No, look, I agree with everything you're saying. I think if you go back to the debate that was really hot back in the late 90s, there was a stockbroker called David Sellers Jones who used to write letters to the AFR every day almost about these off-market buybacks. And his basic argument was that that a dividend as defined under corporations law cannot be paid, has to be paid pro rata, and that these off-market buybacks with their dividend component were not, the dividend component wasn't actually under the corporations law defined as a dividend. And that argument raged on for a couple of years, really. To the extent that the tax office puts that 14% discount, that's what we're arguing, that, you know, in an earlier paper we showed that the equilibrium discount would be around 20%, and that would allow a fairer sharing of the benefit of being able to, of the company being able to buy back below the market price. It would allow a fairer sharing of that benefit between the participants and the non-participants. I guess our basic argument is that that these create a tax distortion, and the tax distortion in a sense goes against what the original aim of the dividend imputation system when it was first introduced was, that there would be no streaming of tax credits. So no ability for investors in the market to actually trade the credits. And, you know, the dividend imputation system is of the tax credits are of benefit only to domestic investors and not foreigners. And so foreigners miss out in any case. And that's an inequity, I agree. But, you know, the foreigners investing into Australia that operates under a dividend imputation system are well aware that they cannot claim the tax credits. There might be some schemes whereby they you know, set up Australian subsidiaries, etc., where they can. But yeah, I don't think that there's any simple answer. I agree. And you with your self-managed super fund, and me with my self-managed super fund, we participate because there's tax benefits to it. Yeah.
Thanks.
Thanks, Paul, for the question. Our third question comes from Michelle. Michelle asks, Christine, do you have any insights into why ASIC provides relief to allow TOMs to be classified as equal access scheme?
That's a good question, Michelle. You probably might have more insights into that than me, but when I sort of dug into some of the discussions from, I can't remember the name of the committee, when buybacks repurchases were first being mooted back in the middle 90s in Australia, there was a tax committee, law committee, or I can't remember the title, I've got it somewhere, where people get together and discuss, and they were trying to set the regulations for buybacks in Australia. And in our search, what I came across is that there were some powerful, again, lobby groups, so big companies wanting this structure to be allowed. And I wonder, and I'm not sure that I've got direct proof of it, but I did actually spend many hours looking for it. I wonder whether there were some large companies, you know, who generated very large franking account balances, who wanted those equal access buybacks to be available to them, even though they weren't, they wouldn't be equal access because they wouldn't be tax advantageous for all marginal tax rate shareholders. I think that has something to do with it. ASIC doesn't actually say in any of its public documents why it gives relief. So do you want to say something, Michelle?
Anything you want to add, Michelle?
She might have gone.
We have time for one more question.
I am here, Christine.
Oh, yeah.
Oh, hello.
Hello. So I couldn't work out how to unmute myself. No, I don't know any more than you do, but I just think it'd be interesting to find out. But I think you're right. It would have been powerful lobby groups.
Yep.
Yeah. And they, you know, it is interesting that they don't disclose why they do things like this. We know.
Yep. Yep.
Anyway,
you know, we're in the current climate where some of the relief that's being granted for share issuance and so forth is they are giving reasons. But with this, I think it was just a build-up of they were looking at the legislation in the UK and they were copying some of that, looking at the legislation in the US. Then we with our dividend imputation system, I think that there were some powerful lobby groups, as you say, who could see that there could be advantages for the company and for shareholders, but not shared equally. Yeah.
Yeah, thanks for that.
Mm-hmm. So Christine, just one more question for you. So with COVID-19, you were mentioning that in 2020 we don't see like tombs. So isn't it the case that the company would still have franking credits sitting in there that they would need to somehow reduce the balance of? So going forward, so post-COVID, would you see the comeback of dooms?
Yes, I think so. I think basically there's a bit of a hiatus because the markets are depressed and companies, I mean, this is one of the things that we've talked about. Companies do these large buybacks, so they buy back the shares, but sometimes at the same time as they're issuing shares. So where are they getting the cash from to buy back the shares? Well, sometimes they're actually issuing shares at the same time or, you know, around the same time. And so now is, you know, not that good a time to be issuing shares. So I suspect just in terms of market activity that's one of the reasons. But as soon as the market starts to pick up, and Paul will be glad to hear this, I'm sure they'll start again. Of course, if the profits are down, for some industry groups, the profits are way down, the tax credits won't build up quite as quickly.
Mm-hmm. All right, thank you very much, Christine, for your insights and answering all those questions. So looking at the time, we'll need to wrap up. So on behalf of Garnet and CGB, I would like to thank Christine for your time in presenting today. And also thank you very much, everyone, for coming along and ask wonderful questions. So
Thank you, everyone.
Hope to see you at other events. Thank you.